All right, event trader here, being joined by with Brett Manning, chart trader. Brett, we haven't had a chance to talk in a little bit, so it's going to be fun. We got a lot of stuff to digest now with the recent fund manager survey out of Bank of America, of course, the Fed meeting yesterday, and a lot of market action. So, with all that in mind, and plus, just as an early precursor, Brett has three triplets running around too that he's doing his daddy work with. So we might have some interruptions here and there, but we should be able to get all the pertinent information out to our subs out there. So, Brett, with that in mind, how are you doing today, buddy?
Yeah, I'm doing good. But yes, so as Gavin said, this may be a little bit unconventional in terms of one of these shows because mommy is out at Stanford and we don't have any childcare help, and it's been just me with 3 5-year-olds, and they are, well, they don't do good at following instructions when it comes to, hey, don't bother me for 45 minutes or an hour. So I don't know what's
Well,
going to
I,
happen here,
I,
but
I
we're going to give it our best shot.
I think Jerome Powell would have the same sentiment about the markets, right?
That's good.
So let's break into it then. Let's not waste any more time, Brett. First, let's recap the Fed here, and I'll just kind of run through some of the items, and then we'll do a discussion on that final two questions. Uh, they hiked the rate 75 basis points, obviously, first time since Bill Clinton was in office. One of the things that I found interesting, and I'll ask you about this, Brett, is economic activity picked up after edging down in Q1. They also changed slight tweak to their inflation language, saying that they were now strongly committed to reducing inflation compared to highly tentative. They did reduce their growth expectations for 2022 and 2023 in their economic projections. Also raised unemployment rate expectations, which we'll talk about shortly. Fed funds futures naturally jumped to the levels that I have up there on the slide. So kind of surprised by this, but no change to the balance sheet unwind plan. And then, of course, Powell hinted at 50 basis points in July, or at least strongly suggested it. Did he have to? And then finally, the final question is, did the Fed regain credibility? And Brett, I guess that is the question that I will pose to you right now.
Yeah, I mean, I think all the rest of it wasn't that important. I
Yeah.
mean, it really, they have a crisis of credibility right now, and I think that the what I think what needed to happen was for, I mean, this is all about in trying to inspire renewed faith in the Fed's ability to captain things, and they've lost that faith. And people don't believe that they can deal with this current inflation problem without crash landing the economy, which is one of the reasons I've been bearish this year. Is I kind of figured that that was going to be where this headed if they were wrong on transitory. Um, and now, they're not. So the Fed is not in control of China's disastrous zero COVID policy. The Fed is not in control of the war in Ukraine. The Fed is not in control of things like semiconductor shortages and stuff like that. But they are in control of how the average agent in the economy changes their behavior based on certain inputs as they start to get the feeling that nobody's really flying the plane right now who knows where the plane is going. And so that's how you get this problem of niche different spikes in different areas that are idiosyncratic or specific to some phenomenon, highly inflationary in little points, gradually becoming broad based and starting to filter into expectations. And then people start to change the way they behave. Consumers start to change the way they behave. Employers start to change the way they behave to accommodate the notion that, well, next month, the month after that, and maybe a year from now, prices are just going to keep rising. So people start to behave differently to adapt to that environment. And that's what causes it to become entrenched and to become maybe a decades long problem if they let it get out of control. So the Fed does have control over getting people to believe that they can get that phenomenon to stop happening and that they can maybe do it without crashing the economy. And if people have faith in that idea, then they'll stop changing the way they're behaving, right? They'll stop behaving as if inflation is now a permanent big problem, and when they stop doing that, then it becomes less broad based, and it actually can change the course of things. And Powell needed to inspire buy-in. He needed to seem like an expert who knows more than anybody else about what's happening and absolutely confident he can deal with it. And I don't, and he'd have to kind of put his own personal credibility on the line to accomplish that. He'd have to make some guarantees, and he could be wrong. And if he's wrong, it's going to be bad for his career. But I just felt like he wasn't willing to take those risks and step up and lead. And I think that's what needed to happen.
Yeah,
And we didn't get that, in my opinion.
yeah, no, I completely agree. I had posted sentiment very similar to that. I thought that a few unforced errors too, Brett. Like again, he stepped up with the we're probably going to go 50 in July. You don't need to do that. I mean, the 50, what was it? It was priced in, and I mean, we could kind of see in the CME Fed Funds futures where 50 basis points is at about 25%, or it's at 16% now. So if you can't get a better measure of the faith
No,
in
right.
Powell right now by looking at the CME Fed Funds futures. Powell telling us that they're probably going to go 50 basis points, yet there's 16% of the people there that think that he will, and 83% say that he's going to
Yeah.
be wrong again and go 75. And that just kind of is a great way of measuring that credibility, I find.
Yes, and it was also a perfect example for exactly what I'm talking about. He could have said we're going 50, that's fine, but make the case and make it like an
Right.
authoritative case that 50 is definitely enough and I know it. And we know what we're doing here and we do not need to go 75. It's going to work out and make the case about these transitory elements and whatever it is. If you're going to do that, you better have a good reason for it and a reason you could sell other people on and get everybody to buy in. And that would be great. Imagine what the market would be doing if the market believed him that we didn't need 75 basis points and then another 75 and then we're going to end the year at 4% or whatever and headed into recession. If people believed instead we'd end the year at 2.75% and inflation would be back down under 3%, what an amazing world that would be. And that would be the soft landing. That would be everything going great. If people bought into that, if people believed him, if people followed his lead on that idea and he presented a credible case and seemed like, somebody who knows more than you or I or anybody else about what's happening, people would buy into it. If you're going to do 50 in July, do 50 in July like you know it. And I just think that he's kind of in this. I mean, the way I didn't want to say it in my notes this morning, but it's kind of like a cover your ass kind of process right now. So
Yeah.
I don't think
And,
anybody's taking personal risk.
right, and I think their comments around economic activity picking back up, that was another odd statement I found, because when you look at the Citigroup economic surprise index, that's down. You
Mm,
saw the St. Louis Fed come out today and basically highlight that we're in a technical recession, more or less, with them lowering the Q2 GDP expectations to 0.0%. So I think that kind of hurts his credibility. And then, the one thing that can pick it back up is if we do start seeing easier inflation data when the PCE comes out in 2 weeks or what have you. But
mm,
unfortunately for the Fed, the first couple of data points that were coming out with those housing starts and building permits didn't necessarily match up with the picture that they were painting, nor did the Philly Fed for that matter.
right.
So, okay, move. Anything else on the Fed that you want to add, Brett, before we
No,
move
not really.
along? Okay. Let's take a look at what the sentiment data is like out there. We've got a couple of AAII charts here, just kind of breaking down the data in different ways. But obviously, this is from just released this morning. The bullish sentiment drops to 19.4%. Neutral fell to 22.2% from 32%. And all those people went bearish, which is now up to 58%, the highest level since the end of April. That would have come shortly after we got the Amazon report and everything like that. Brett, I know you always like to look at the 4-week moving average, so I put those numbers down there. And you can see people are pretty bearish out there. Now, generally, we'd be talking about this being an extreme, Brett, and I'm going to show a few more slides here too. This is just the week ending data breaking down in a little bit different format here. You can kind of see the progress going on, how it pertains to historical averages, and how far away we are from the bullish 1-year highs and how close we are to the bearish 1-year highs. This is an 8-week chart. It's a little sloppy. I'm just trying to do a better job of grabbing it from the Excel sheet. uh here, but this, anybody that's looking, you could go roll back down through, get, this is the 8 week average. And then Brett, you presented a chart to me with the AAII bull ratio bear, which I know you also like to look at, and you
Mhm.
had some pretty important information on the 10 period moving average from this. So what's your thoughts on AAII after taking a look at this data here?
So AAII can be useless or it can be really useful. And the times when it's really useful, I mean, look, in different environments, you find different average levels. So we are transitioning to what feels like an entirely different world right now in markets from anything that we've seen over several decades. So you got to take that with a grain of salt because this is all comparing the last few decades, which have been a very different kind of world. So maybe we're dealing with apples to oranges comparisons here, but the main rule that I use with this data point is it's really important when it does what I call festering. When it just kind of gets to a really extreme level and then it can't get away from that for weeks and weeks and weeks. And that really I think is where you start to translate the idea of, hey, this is survey responses, but they start to show you positioning. And I think probably validly this is showing us positioning now. What this shows is if you can look at this chart and see the green line, you got to kind of filter out the blue line. The blue line is the raw 1 week data. The bull ratio, first of all, is it's just the ratio of bulls to bears. I think it's bulls plus bears. So bulls divided by bulls plus bears. So it takes out the neutrals. The point is, you take out the neutrals completely. So anybody with a directional opinion is finding the ratio of bulls to bears inside of that notion. So this is the green line is the 10-week moving average, and it's hard to see, but I looked very closely at this, and I can tell you that right now it's under 30, the 10-week moving average, the green line. It's the first time. So you're looking at 10 weeks of data. That's the average point. So this is festering. It's under 30 for the first time in just over 30 years. So it didn't get this low in the depths of the 2008 crisis or the pandemic or even the dot-com bubble blow up. Like this is a festering in a bearish extreme to a level that we haven't seen since we really had, a different environment, where people had before really all the tremendous growthiness that erupted around technology in the 1990s.
Brett,
So,
how much of this do you think is just from the idea that there's so much information out there now that, I mean, we kind of see these extremes come in a lot more frequently, it feels like. Do you think that factors in?
well, this is the first time we've seen it in 30 years. So we haven't seen
Yeah.
this type of extreme in a long, long time.
Yeah. Yeah. I guess if you're
But
going
it
back
may,
through COVID and
the
stuff.
one caution I would have is it could be finding a new average. So if you go back to the 1980s, it was in this zone, kind of not often, but it was, every couple of years. Like it was just people were just less willing to believe in great things ahead during that period. And in terms of markets, because they've been through, you got a lot of people who are active investors then who are coming out of 16 years of sideways movement, from what was it, the late 60s to the early 80s. Basically, the market did nothing. Like we didn't have a visceral experience of a Super Bowl market in the sort of cultural zeitgeist. And so people in the 1980s, it was just constant disbelief when the market started going up. It's like this is going to fall back down because they were used to almost a generation of a stock market that went nowhere. And I think that those sorts of things leave a stain, and people need to get faith again that you can have a stock market that increases in value over time at all. And I think the 1990s proved that, and people got excited about that possibility. And so it's hard for them to go back to this notion that it's not going to go up. So that period just had a different average level. Because this question, a bull versus a bear, is just, 6 months from now, is the market going to be higher or lower than it currently is? And it was just easier coming out of the 60s and 70s for people to just believe anytime the market went up, and it went up continuously throughout the 1980s, that it was always going to fall apart soon, because that's what, people had experienced for so long. And I think that really impacted how this data point was collected. So now we're back in, people are feeling that way again. And I think that is important because I think it translates to positioning. And if this world is going to turn out, the Fed gets inflation under control and we start to kind of flip back into a little bit of like a rejuvenated feeling that, hey, maybe growth can happen again, people aren't positioned for that, and things could take off given this data point. So it's
Yeah.
an important data point, I think.
Yeah, no, it's one that we'll continue to follow along, see if they can start picking the average up. But and we'll get into a little bit more on the positioning and capitulation argument as well shortly. Another interesting item, and so a lot of the market moves can certainly be discussed as deleveraging over. I mean, we haven't really had a lot of big puke days. I mean, there's certainly been some aggressive selling days, but for the most part, this market's been stair stepping its way down, which a lot of that's had to do with deleveraging. And I think the margin debt rollover chart, Brett, that you presented here,
And I
certainly,
presented it first in our April. I just wanted to. This is the same chart, so I
yeah,
just put the same slide back in because I wanted to kind of have a, we've seen what happened since April when you and I had that last conversation.
yeah,
Um,
and it
we were
shows
at 4,500 or 4,400 or something.
right, and it just kind of shows how people are pulling back on that in order to. I mean, number one, it's just getting more expensive, right?
Well, there
Uh,
was stupid leverage, right?
yeah,
There was period of stupid, like these spikes. But that's like,
and you
hey,
wonder how
every
much
once in
of
a
it was
while,
backed by like Bitcoin and stuff like
who
that.
knows, buddy? Every once in a while, people get stupid in markets for a little bit, and then when they do, and then they start to become less stupid, that's when you get that's when you get serious bear markets. It's that the upside was silly for a bit and wasn't earned, and then you've got to mean revert and then go through the mean reversion and kind of have the overshot. So you got the overshot to the upside, then you get the overshot to the downside. You can see it in the market prices and you can see it in the leverage, right? You can see these lines all look the same. It's in a channel, it's in a healthy channel, and then it spikes way up and then it goes way down, right? The only time it violates the bottom is right after it violates the top in this margin debt chart, right?
Right.
So you've got these people overshoot one way and they overshoot the other way, and it's that combination of things that causes real bear markets in terms of how people interface with the equities markets today. It's not so much about stock picking; it's about leverage and indexed instruments. And people got really fired up. They've gotten really fired up. They got really fired up in 2000. They got really fired up in 2007, and they got really fired up last year and too much leverage, and it was silly leverage, and now it's coming back out of the system, and that just exposes the air pocket underneath the market, and that's what we're working through, and what I was trying to communicate um, a couple months ago in our last show.
Now, the margin, Brett, does that measure all options activity and everything like that, or is this just kind of going off of like what they're able to measure off of interactive broker accounts or something?
It's just NYSE equities allocation, but it's a sample. Look at it this way: it's like when you got an election, and you do a poll to try to figure out which candidate. You don't have to ask every voter to figure out which candidate's going to win. You just need to take a sample. And so this, I think, probably you could do different charts of different things that would have to do with leverage in one way or another, and they probably all look a little bit like this. But this is margin debt for NYSE traded equities.
All right. Moving along, a couple items of interest, Brett, uh, just some random items. Number one, according to Fed data at the end of 2021, 24.3% of US household assets were in equities. So you can kind of get a feeling of how badly pocketbooks are getting hit right here. I mean, if a quarter of your value is tied up and now in bear markets, that's definitely a big hit to the consumer.
Do you know where that stands historically?
I do not have a historical number on that, no.
Okay.
But I was just kind of, it was a data point that I had stumbled across that I found pretty interesting in terms of,
I'm just guessing it's abnormal. I bet you it looks kind of like the last chart a little bit. I'm just guessing, but I want to look into it after the show.
yeah, I'll get an answer for that. It's in the H8 data, I believe. So
Okay.
I'll take a peek at that. But
That would be interesting.
I was basically just looking to get some numbers that when you're looking at when the market ticks down, and we are keeping an eye out on the markets here. The S&P
Getting
has
hammered.
slipped too. a session low at 36.44, like we were saying before. It tried to grind higher. There wasn't a bid nary to be found. So
Yeah,
we're just getting that rollover here, and we'll be getting into a number that we're getting close to in a bit here, Brett. But
it's not impossible. This could get a little disorderly at this point after the last few days.
yeah, one would think. I mean, it's been elevated in the VIX and certainly in the put call ratio today, up around 1.25%. So we'll be watching this activity here, and don't be surprised if either of us fires off a trade, possibly. U.S. household assets, Brett, could decline 6 trillion, 4% in Q2 alone due to the market sell-off. So I mean, that's just kind of giving you an idea of the amount of value that was in there. Basically, what we've lost so far, I think, something along the lines of 24 trillion, which is the equivalent to 1 year of the entire U.S. GDP. Just huge numbers of
That'll put
money
some
that's being
turtles in
lost.
their shells.
Yes. Yeah. Just kind of building off what Brett's been talking about here. A common theme that the Fed put will not be triggered anytime soon, and the economy has a higher equity beta, meaning a little bit more volatility than at any time in decades. Would you agree with that, Brett? With the higher
Say it again.
equity beta, the higher equity beta that the market has more volatility in it than at any time in decades. Do you find that at this
Well, I
point?
mean, it's an objective fact if it is, right?
Yeah, yeah.
I mean,
Well, I was just kind of throwing out the theory, and again, we're going to get into that Fed put here because that's one of the questions on the fund manager survey, and it's our actual next data point here, which according to that, it's fallen to 34.53 from 35.29. That's just an average of the what you call it of the participants in the survey. Now, obviously, that's still about 200 points away from here, Brett. But I guess here's my problem with the Fed put. What would get the Fed to move off of, to come back in and get off of their aggressive policy? That's going to be something that's going to be real difficult for us to ascertain moving forward. And I know we'll have Brett back on here in a second.
okay, I'm
Uh,
back.
okay,
Sorry, what was the question?
so it was basically around the Fed put. So the S&P, according to the Bank of America survey, has it closer to 34.53. The prior one was 35.29. We're obviously starting to get closer to that. Do you think that this is going to be one of those keep moving the goalposts down to where people think the Fed put is? I mean, I don't even know what the Fed could really do at this point.
This we've
To
debated this before. I just don't like even the idea of trying to come up with this number. You successfully, I think, made a point that makes it a little better for me in our last conversation where I just kind of said I think trying to pick a level like that is silly. But I guess you can try to find a way to say that that is going to represent some level of a psychological kind of critical line, and you can measure it in lots of different ways, and one of them would be the S&P level. But I just kind of feel like it's not gonna come down to where the S&P is. That's been my position. That's why I've had such an easy time continuing to short. Is because the S&P's level is it's. I mean, look where we are now. Look how much we've come off, and yet we just had our worst inflation point yet. Right? So the only way that this can translate is if prices get so hammered in equities that people feel such a wealth effect that they stop spending completely and then inflation falls a lot, right? And then that's
right,
when the Fed will change. It's because the inflation falls a lot. Like my view with these guys, just like in our last strategy meeting, I said, I mean, if Powell came up with a poster of Volcker on his dorm room wall. Like, I mean, that's the time period for this guy when he was cutting his teeth.
yeah,
It's the heroic work of Paul Volcker, who just ripped rates at the short end up above 10%. When did he get to like 14% or something? Took us into two recessions, and then that unleashed like 4 decades of disinflationary growth. And it was everything like that took us out of 16 years of malaise and launched everything. And there's lots of other factors, obviously, in terms of opening up global trade and technology changes and all sorts of stuff. um and a single superpower. But for Powell, as like his sense of what you do in a situation like this, it's not at this point. It's you've got to make sure that you completely kill the inflation infection before you worry about anything else, because that's the thing that can cause us 2 decades of pain if we don't get it under control now. And I think he'll take, I think he'll take things wherever they have to go. He'll bring us into recession. He'll bring the S&P to, under 3,000 without blinking if there's still the sense that he hasn't killed the infection. So that's my take on it. Now, maybe that translates into an S&P level. The inflation, the infection must be dead if the S&P is at 3,400. I don't know, but I just don't think of it in terms of there's a level on the S&P where Powell's going to change course, unless he sees that he's already turned the tide on the inflation picture.
Yeah, I completely agree. I think putting inflation to bed should be first and foremost, and I think that would see a more positive reaction to the markets. And another potential positive reaction would be, we could finally see some serious peace talks in Russia and Ukraine. And I bring that up, Brett, because the 1450 headline that just hit the wires here. EU leaders support Ukraine's application to the EU and say that peace talk timeline with Russia is up to Ukraine. This happened right when we got that little dip down there. That should be interesting because I get the feeling that the two sides are trying to force each other to the table. And that's definitely an unknown that could really present a face-off rally, a rip your face off rally potentially. So, you got any thoughts on that headline?
So the headline is
EU leaders support Ukraine's
yeah. What's the
application.
positive here?
I'm not saying it's positive.
Oh, 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 oh.
What I'm saying is that I think that we're starting to see EU leaders pushing Ukraine
Oh, I see.
to just give up that land at this point.
Right,
This obviously takes care of some of the wheat supplies, food
right,
supplies,
sure.
oil supplies, net gas, all that stuff, right? It seems to me
Well,
like maybe they're
right,
figuring that if they start talking about this application for the Ukraine, perhaps that Russia looks at that and be like, oh, well, maybe we'll come to the table and our ship will be, we take this land, Ukraine doesn't go into NATO, and we go from there.
sure.
So
I mean,
that's why
if
I find this headline a little interesting.
my heuristic for gauging what's happening here is that Vladimir Putin seems like he has a brain tumor, and
Yeah.
I mean that worked on every level for me. I knew somebody during a period who was a good contact of my wife's, who was working at a startup out in California, and he started just acting really strange for a period, and then he died, and then they found out he had a brain tumor, and he was doing really strange things, like becoming really obsessive about like copywriting every single thing he wrote, even if it was on like a little pad of paper. Like he would break
Yeah.
copyright his name, and he was a former CEO of like a huge global education company, and he just started to seem just kind of really batty and making some very strange decisions and being really passionate about them, and it just turned out to be a brain tumor. And to me, it's like I could imagine that being kind of an explanation. I know a lot of people disagree and say he's acting perfectly rationally. I don't see it, but
Yeah.
it's tough to gauge how Vladimir Putin's going to react to anything. And it certainly seems like he's not going to be upfront about anything actually to do. And we've seen so many people have lost faith. The idea of one big headline lead to a resolution you can have faith in, even if it's true. It's just we've seen so many crying wolf moments in this process of, oh, here's reason for hope. The Russian troop withdrawal, or the whatever it is, the peace treaty talks, and there's been so many steps like that, and every single one of them has turned out to be just part of the process of negotiating the power and the struggle, and trying to manage a situation that's terrible for everybody involved. That it seems like, I don't know if people will have faith in any kind of breaking news on that level now.
Yeah, and this is a New York Times story, just for anybody who's curious. So we'll keep an eye out on that. But moving along here, Brett, the final item of interest, just this morning, Atlanta Fed's GDP now lowered to flat from 0.9%. We, of course, were minus 1.9% in Q1. So I guess the question is, are we already in a technical recession? And the second question is, does it even matter? Because it's been priced in, right?
Yeah, I mean, I think the market's clearly saying, this is what's going to happen. And as we talked last time, recessions. Here's how recessions happen. For anybody who's been through a couple cycles, recessions happen when things seem like they're changing and the market's changing a lot, but the data still looks perfectly good. And then a year later, like the Economic Cycles Institute comes out and the Fed comes out and all the data is revised, and you realize that a year ago we were in recession. And data that you see right now, most of the data actually is it's so heavily the economy is volatile. So it's really difficult to say. I tend to put faith in the notion that we we have the process that risk aversion versus risk acceptance governs everything. It governs market prices. It governs economic activity. People kind of heard around, everybody gets really risk accepting during certain periods, and they get really risk averse during other periods. So
Yeah. Okay, and just seeing the markets holding up around that 3650 area and trying to work their way up. So we'll keep an eye out on that. Moving on to the Bank of America Fund Manager Survey, Brett. The one important item: the survey closed the day before the CPI report. So, I would
yeah,
have liked
that
to
was
have seen.
interesting.
I would
Sure.
have liked to have seen some of the responses post
Can you
CPI, of
imagine?
course.
It was
Uh,
already insane.
yes.
Yeah.
So and that's going to be the thing, right, Brett? I mean, some of the numbers were pretty ugly, and I think that they would have been a lot uglier if people were asked that while that CPI report was crossing the wires. So some of the top takeaways: all-time low in global optimism. That was net minus 73%. Stagflation fears the highest since June of 2008. Profit outlook the worst since September 2008. That was, of course, the same month as Lehman. Cash levels fallen to 5.6% from 6.1%, which is a little bit off from some of the numbers that we were seeing in their flow data. And then, of course, the most crowded long trade was commodities, and the dollar jumped up to number 2 on that. It hadn't even been on the radar. So we'll take a closer look at all these points coming up here now. Some items of interest come in from the flow data, Brett. I mean, we obviously know commodities have been skyrocketing here. There's some numbers year to date on nat gas, gasoline, oil, iron ore, wheat, nickel, soybean, and cotton. So before I move on from this point, Brett, what's your thoughts here on oil, and if there's any of these commodities that you want to discuss?
I mean, we got quite. I feel like we're in a situation where it's going to be tough to knock it down. But obviously, if we have, we're really turning where people look price in a recession, then you're going to.
Hey, Brett, I'm having a tough time with you. Just
As my connect.
yeah,
Yeah, that's few. Well, let me know. Can you hear me right now?
I hear you. You're kind of doing that matrix thing right now.
Oh, really?
Yeah.
Okay. Well, I guess there's nothing we could do unless you want we want to take a break and I go to hotspot,
Um.
which would be a
Yeah.
different connection.
Yeah.
So why don't I
Maybe.
log out? I'll go to hotspot. You try to fill the air. You want to do that?
Yeah. Yeah. We'll do that right now. So
All right.
I'll give you a second. So
Yep.
I'll continue on through this items of interest. And we'll pull Brett back in and recap this. But the Bank of Japan. They're the sole central bank left fighting deflation. People are calling it the Soichi Yokoi trade. That is the Japanese soldier that went running off into the woods on one of the islands and hid there for 45 years, still thinking that the World War II was going on. And that's kind of how people are looking at the Bank of Japan. I bring that up because the Bank of Japan is going to be meeting later tonight, the final central bank of what's been a pretty busy week on the central bank front. So we'll get some more details from them. Um, EU CPI plus 8.1%, PPI plus 37%. Yet here we are sitting around with ECB rates down in the negative territory, and they're still buying bonds. It seems completely behind the curve going on right now. So uh, we did see a pretty good rally in the euro. We'll ask Brett about that shortly here. And I think part of that has to do with the idea that I think people are ramping up with the idea that the ECB could be maybe planning a special operation where they're going to start raising rates, or start really jawboning the July meeting as the time when they're planning on moving aggressively on that front. So something for us to keep an eye out on. European bond yields naturally of interest. We've seen the Greek yield, the spread between Greek and Italian and Spanish debt compared to German debt move back to levels not seen in the last 2 years or so, and that is cause for concern in the European markets. It certainly makes the ECB's job a lot tougher because they're going to have to figure out a way to unwind their stimulus right now and keep those spreads tighter and have people avoiding going into the safer German bonds. So really tough time for the ECB, and it just kind of has me a little cautious on the area. 54 billion flows to cash, and that's why I was talking about that one data point of of cash dropping from 6.1 to 5.6. It certainly seems like there could be a
That
little bit of off commentary from that.
Gavin, can you hear me?
I can hear you perfectly now.
All right, so I'm on the hotspot now. It should be different.
Beautiful, beautiful. So Brett, real quick, you were saying on the commodities front.
Well, yeah. I mean, I guess the we are seeing. I tend to think about this in very long time frame, because the commodities market is. I mean, you've got sentiment, you've got short term dynamics, you've got technicals, but the very long time frame is a real problem. And over the next number of years, we're going to start to see major shortages in everything related to fossil fuels, because nobody's investing in new production capacity, and we haven't really for the last 15 years, and demand really isn't disappearing. So the transition away from fossil fuels is going to be probably, I think, a much more difficult process than people realize, and it could be really, really nasty. But in the short term, if we head into a recession, possibly in terms of global growth, but in the United States, that's obviously going to provide an opportunity for oil to spill a bit. So, but I did pick up. You were talking about the European sovereign
Yeah,
spreads a little bit, which I think is almost more interesting to analyze.
yeah. No, exactly. So, I started off first. Talked about the BOJ. Last one's fighting deflation. Have you seen anybody calling it the Sochi Yokoi trade at all?
No, what's that
Do
reference
you
to?
know who that's the reference to the guy who ran off into the woods for 45 years and still thought World War II was going on? Which
Yeah,
I think is
right.
a
All right.
hysterical name for what the BOJ is doing right now.
Yeah, no, it's really interesting.
Yeah, and then we talked about briefly mentioned the ECB with CPI running at 8.1%, PPI up 37%, yet the ECB still floundering around, and that led into the discussion around the European bond yields and the separation between Germany and the southern economies there. And I was basically saying how that really increases the level of difficulty for the ECB. So, what's your thoughts on that, Brett?
Well, so my thoughts are every cycle I kind of say, the euro's at risk, because it always is. This one's interesting because the last time around, Draghi was in a deflationary environment, which means he could just print infinite amounts of money and use it to backstop everything on the periphery, right? Like
Yeah.
in one form or another, that's the game plan. And so they're kind of making statements like they're gonna let the reinvestment kind of push out to the periphery now. I mean, that seems to be the idea, as as things mature and they go to run off and they reinvest. They're going to concentrate more of the reinvestment in peripheral bond yields, as if that's going to provide some kind of cushion. But the fact of the matter is, they're not in a situation where they can get this gigantic stick out and say, we've got this gigantic stick, and if you bet against this, we're going to clobber you with it, because we can print an infinite amount of money and use it to backstop these other countries. And in an inflationary environment, they can't do that. So I think that people are going to challenge that stick. People are going to push this. I really believe that we're going to get to the point where sometime over the next few months, we're going to start to see these spreads blow out wider, and the people with deep pockets are going to start to go after them and really try to drive those spreads wide and see if something
Try to
breaks.
break the bank,
Yeah,
similar to
basically,
Soros.
yeah, absolutely, because it's
Yeah,
there.
yeah,
Because what can they do?
they
If
can't
they're
do
dealing
anything.
with inflation, they're dealing with natural gas prices, or the Russia situation. Hold on one second, sweetie. Then you're really going to be up against, like, they're not in the same situation Draghi was. He can't. They can't sit there and say whatever it takes, the euro is forever, if they are dealing with inflation way above their mandate. And think about Germany's relationship with inflation,
Yeah,
and it's Germany
not
that's
a
going to have
pleasant
to
one.
effectively subsidize, you know, Portugal, Spain, Italy, etc. So it's really going to be an interesting situation. Now, maybe the cycle turns out better. Maybe we get some kind of soft landing. It's always the cycle. I mean, when you go into this sort of global growth downturn, that's when everything kind of becomes, these spreads start to blow out because they're just going to have different outcomes in these situations. And when people start to lose faith and lose confidence, then they've got very different default potential. And so rates are going to adjust accordingly. And this is really a situation where the ECB is probably not going to have the ability to just, have a blank check backstop everything. So it's going to be
Yeah,
really interesting.
and not to mention the legality of it all too, Brett, where technically the ECB is not even allowed to do what they're trying to do.
Yeah, they can
And
change the
that's
rules though,
basically
but
they
yeah.
can change the rules, but again, like you said, they need Germany on board. So okay, so
Want to say hi, sweetie?
Hi.
hey girl.
That's Sylvie Rose. She's my head analyst.
I like
With
it. I
a
like
lot of people are in here. I'm talking to lots of people. Okay. Uh,
it.
sweetie, I got to keep doing this. Okay.
Daddy.
Hold on one second, Kat.
No problem. All right. The final two data points on this. Just really more items of note. In the MSCI, 33%. This is 952 out of 2,910 companies are trading below their 2018 highs, and 40% of NASDAQ companies now trading below their 2018 highs. So basically, we're looking at a lost 4 years here. Um, so, and then again, inflation shock is not over, and the rate shock's just starting. And I think that's where, Brett will and I would agree that there's still more pain to be had here as we work through some of this mess. I would say that markets now are about 25 points off the lows, seeing a little bit of buying coming in around this 3650 level. So that's of interest. So, but we'll kind of just mow through
Okay.
some of these slides here because we've already kind of discussed it. But
Yeah, and a
uh,
lot of them are going to be just kind of recycling the same set of points, just from different
exactly.
angles.
So this one's interesting though, and I do have a quick question for you on it. Global growth optimism. We could see it way ahead of positioning here. So do you expect this just to kind of follow suit and for us to drip down into that -50, -75 type area here in
Yeah. Oh, right. So
for
the
the
overweight.
overweight
Yeah. I mean,
equities?
I'm sure that it is right now. I mean, this
Yeah,
was, this was
pre CPI again.
Thursday of last week, and we're starting to we got that lead blanket vibe going on. So, obviously, yeah. Well, and it's going to be interesting. Oh, no, no, don't do that. It's going to be, and I'm just getting inundated now. There's just going to be triplets happening to me, and there's no
No
way around it.
worries.
Sweetie, come on. So yeah, this is. I mean, there's also the interesting possibility that we've seen underweight U.S. for the first time in a long time lately, and
Yeah.
overweight, Japan and certain other areas. And it's interesting to see if this is kind of like, hey, maybe the Fed is going to do 75, 75, and then I mean, look, the dollar's getting hammered today, hammered, right? And rates are down, and I wonder if we're going to see a situation where it's sort of like passing the baton. The next up for getting hammered is going to be, equities in Japan or wherever else. Like we start to see it kind of who's the next central bank to start to look like the Fed over a few months,
Yeah.
right? So I
Yeah.
wonder if that's kind of part of it. So we may see. I mean, this is overweight, obviously, equities everywhere, but I wonder if the devil's in the details in terms of geographic allocation.
Um, do you find the move in the euro is due to primarily expectations for them to get a little bit more aggressive? What,
Well, I
what,
mean,
what what's your
it's
thought on
broad
the euro?
based though. I mean,
Yeah.
it's like the euros do it, but look at I mean, obviously the Swissy because they had a surprise,
Right.
a genuine surprise and went 50. But I mean, you look at it, it's I mean the pound is powering higher, the Australian dollar is powering higher, the New Zealand dollar is powering higher. It's sort of everything. It's really people are looking for individual stories, but it's just the dollar's getting hammered.
Yeah. Yeah. Which is interesting because usually uh, that would be the safe haven that everybody would be going into, but certainly not the case today.
No, you're right.
All right. So moving on, stagflation worries. Not a real surprise going on here. It's back down at levels that we've seen around all the great financial crises and stuff. So, that's definitely something of concern for the markets, and the data has really been bearing that out. We also have expectations for profits to at their lowest levels in decades here as well, as people are really concerned about the impact of inflation on the margin lines. And we're just starting to get into the area of analysts cutting their levels here, but we haven't really seen a lot of pre-announcements yet. Brett, are you expecting to pick up in that front?
Say it one more time. I'm sorry.
The pre-announcements, are you expecting
Oh
to pick
yeah.
up
Well, I mean, I would
in
think
that?
so, right? I mean,
Yeah.
it's unless it's sort of like everybody knows everybody's going to be saying it, so they don't need to pre-announce. I don't know. Why put a spotlight on me? Everybody's going to have a disastrous kind of shift. I
Yeah.
would I would I mean you're probably better equipped to answer this question because I mean, really you focus more on company messaging around earnings than I do.
Yeah, yeah. Well, I got to say, one of the things I've been kind of impressed with is that the earnings announcements, the pre-announcements haven't been as bad. I mean, there's certainly been a couple of poor ones. Snap, obviously, jumping out. Microsoft, that was due to FX headwinds. This dollar move today kind of helps Microsoft on that front.
Right, but I
Um,
think it's gonna be like the targets, and I mean those like
yeah.
you got this just huge pinch going on.
Well, there'll be winners and losers because there's been three steel companies out in the last 24 hours, and all of them had great outlooks.
Oh, of course, yeah. I mean,
Steel Dynamics, Nucor,
right,
CMC. So,
right.
um,
They're the reason why everything's so expensive for everybody else. So
yeah, pretty much. So, um, okay, moving along. Here we've got, okay, this is an interesting one because I think this is a key differentiator compared to the great financial crisis, Brett, where the number one thing people want to see is for companies to pay off debt, right? That's that light blue line. The dark blue line, that's the increased capital spend. Obviously, everybody wants them to rein that in. And then the bottom yellow line, that's returning cash to shareholders, buybacks,
this
dividends.
is turtles again,
This
right?
is turtles,
When
exactly.
when you get to the part of the cycle where they say, just make sure that you have any money at all. Don't invest. Don't give money to shareholders. Just prepare for the storm. Like it becomes a self fulfilling prophecy, and that's what people are feeling.
Yeah, but I think one of the interesting aspects of it, Brett, this time around is look at this sheet, this chart. The number of people that believe companies are over leveraged, and that's pulled way in from late 2020. And we have it down at its lowest level since about 2018 or so. So that I think that's important when we look at it. And you can talk about the consumer balance sheet, although I'm sure that that's getting eroded pretty quickly with some of the inflationary pressures. So, how do you view the balance sheet backdrop for the consumer and corporates this time around compared to
Well,
2007 and 9, and how that makes a difference here?
Well, one thing I would point out is that I think we talked about a couple years ago that the pandemic was this weird kind of gift for corporate balance sheets because there was just a huge amount of commercial paper rolled over, right? Right? Like
Right.
it was just set that way, right? You had 3 and 5 year notes and stuff that was all just kind of coming together in a massive rollover, I think in fall 2020 when rates were nothing. So I think the one of the reasons why this chart looks like it possibly looks like it does is because we went through this massive corporate refinancing wave during a period when rates were nothing, which makes it easy. Like those are still kind of fixed in place in a lot of cases.
What happens when they come due in 2025 and stuff, and the
They're
levels are
going to be
about
trouble,
300
right?
basis
Exactly.
points higher?
Absolutely.
That's going to be an
We're going
interesting
to need
story
another
down the road.
pandemic.
Yeah, yeah, right. Go play with some monkeys, right?
Yeah.
So, or your bats or whatever,
Bat soup.
whatever is
Have some bat
spreading.
soup.
All right, levels of risk, no surprise here, right, Brett? I mean, obviously, again, the turtle situation here, where everyone's pulled back in, and we're basically at the lowest level since 2009.
Absolutely.
That also would be something that would take place in your margin chart that we were talking about before.
Sure. Right.
So all playing out to theme tail risks. So this one I kind of find interesting. So hawkish central banks, the biggest tail risk at 32%. Global recession pulled back a little bit. Inflation popped higher. Uh, here's my problem. I guess all three of them are kind of intertwined, and they all can't be risks, right? I mean, if you're afraid
Well,
about, unless you're
you're
saying, okay, well,
sampling different
inflation
people, I
drives
guess. Yeah.
hawkish central banks, which is going to cause the recession, which basically means the three basically make up
Well, I think they can
84% of it or
absolutely.
whatever.
I think they absolutely can go together. It's one of the reasons why I was so bearish earlier this year. This is the first time in a long, long time when those concepts can go together. That's the
Right.
point.
Okay.
That's why the
Yeah.
market looks like it does, because every other time this was impossible for these things to all happen at the same time. You could have a global recession with central banks continuing to be hawkish right into the teeth of it. Right? That's the point here. That's why this looks like it does, because if we fall into negative growth with CPI at 8%, you could say the Fed will just look around the corner and say, I don't know if that's where this Fed is. Like, it's possible to have, I mean, oil could be at $160 a barrel. The war could heat up in Ukraine, China supply chains, blah, blah, right? And people just believe inflation is not going to come down. It's called the misery rate in the 70s,
Yeah.
right? I mean, it's unemployment rate plus inflation rate. You can have them together. And we have a misery rate possibility, right now brewing. And then I think that's more than anything, that's why the selling is so persistent, is that there isn't this moment where, oh, growth is slowing down, the Fed's going to pivot and start to, cut rates
Well,
again.
that goes back to the Fed put argument too, right?
Right. So it,
So,
it it could happen. It's just it's not guaranteed that we could head into a recession, and a month after we're in recession, the Fed hikes a lot, and it'd be the first time since you and I were just a glint in our dad's eyes that was
yeah.
the case.
Well, in number four, we got a systemic credit event. To be clear, we haven't seen that in the data yet, but I know, Brett, we were talking about yet. So something for us to keep an eye out on. I did see, I think it was Revlon filed for bankruptcy or something, a drop off in the Ukraine Russia concern there. And we had a pickup in COVID-19. I think that has more to do with China's shutdowns than the actual virus itself. And you can see cryptocurrencies are starting to make their way in there because I don't think anybody knows how leveraged that is. You got any thoughts on the cryptos, Brett?
Sorry, I'm having an eruption of tantruming right now.
All good.
So I think they're making peace right now. So I'm trying to just let them see if they can work things out for this, and it's so
Just like
sorry.
Pal.
Yeah. I mean, I was trying to, yeah, right. So okay, so I'm hurting 5-year-olds right now. But so ask it again. I'm sorry.
So basically, my question was on cryptocurrencies. You got any thoughts on that in terms of how they could be playing in with the leverage and things along those lines?
Well, I mean, it's just such a turtles thing. I mean, it's so dead center bullseye of. I mean, look, in a really risk averse environment, the concept of especially non-Bitcoin sort of peripheral cryptocurrencies having any value at all is ridiculous, right? I mean, or NFTs or something like the idea that a 12-year-old doing little pixelated doodles of a cat face.
Selling it for 250K.
Right. So the idea that that's worth something is a phenomenon related to, and I love one of the pictures I had in a webinar I did like in 2016 or something, where I had this little graphic where there was
Tulips.
a double-sided arrow, and one side of it was this turtle where you just saw a turtle shell with little eyeballs looking out of the dark part, and then the other side was a turtle with a party hat on, completely out of his shell, and a shell sitting next to him, and he had a for sale sign on the shell. Right, like
Yeah.
that to me. There's two ends of a spectrum there. And that party hat turtle who doesn't need a shell anymore at all. He's willing to sell the shell and buy a TV with the proceeds or whatever. That the idea that those little pixelated cat faces are worth 250,000 is a phenomenon that can only happen in that kind of environment. And when you start to slide to the other end of that spectrum, which we always will oscillate back and forth between these two ends of this spectrum of risk acceptance versus risk aversion, when you move back toward the turtle who's just two eyeballs from the darkness of inside his shell shivering, that those cat faces are worth zero for sure. And a lot of peripheral cryptocurrencies are worth zero for sure. And people who we built up a lending system around things that in a different context will be worth zero for sure. And people are lending real money out there. No doubt at some point we'll be back at that party hat side of the spectrum, and these things will be awesome. But when what's going to survive the valley of death in this process, I don't know. But I imagine that there's going to be an enormous amount of destruction of what was seen as capital, but turns out not to have been capital, and that's at the base of chains of other things, financing all sorts of other stuff that is real world consequences, which just feeds on the same process of getting further and further toward that absolute end of risk aversion. When you start to blow up pieces of balance sheets where there was assumptions about value that turned out to be unsustainable when you shift the lens or the context. And I think that Bitcoin is such a perfect example of that spectrum, and the cryptocurrency space and the NFT space and these new digital assets, because in the post-apocalyptic kind of world of the other end of that spectrum, when you've got market crashes and people just looking for cash and stuff, um, um, in that universe, all those things you're going to look really different by the light of that universe, and it's really going to be interesting to have Bitcoin so established going through this cyclical turn, because I think it's going to be such a good marker of where that sentiment picture is in terms of how people feel
Yeah,
about
it's
the
it's been
value of
just a
things.
great risk sentiment measure
Absolutely.
for sure. I mean, you can see it on a daily basis when the Ethereum or Bitcoin ETFs are leading the way. Usually, that's just a dead cat bounce and leading to some further rollover. So let's just put it this way: Kindleberger, somebody will have to go in and add a chapter to his Maniacs Panics
Hold on
Crash.
once. I'm sorry.
No problem. So we'll just kind of move along here. Um, Rate expectations. This is up to, it's at 7.6 rate hikes. That was down from 7.9 again. This is before the Fed or before the CPI data was released. So this chart, we're probably going to have to make a couple adjustments to. I think it's going to be up closer to 8 to 9 at this point. Now, again, this would have been before the 3 the Fed just did, right? So that would be, according to this, expecting another 4.6 rate hikes in this cycle. However, if you look at the current CME Fed funds futures rate right now, that is pointing towards another 7 rates coming in on top of that. So that would have had this average rate expectations at about 10.6. So this is jacked up a lot. And of course, we've seen that all throughout the Fed minutes and everything. I don't think that there's anything particularly surprising on that
Be a
aspect.
team, guys. Okay. I know. Good job. Okay. All right. Help Daddy
Oh.
out here. All right. Sorry about that.
No problem at all. The interest of working at home, right? Right. I just had the rate expectations chart again. This was before the CPI number, so I think right now CME's pushing another 7 rate hikes. This is following the 3 we got from yesterday. So this would have had this up at 10.6. So basically in line with what we've been seeing with the CME Fed funds futures, and at this point now what the Fed's kind of pointing out, right?
Yeah, I mean, well, it's just it's amazing when you go This is before that Friday,
Yeah,
right? So I mean, it's
exactly.
amazing what happened after that. You boom to 75, boom, next one's 75, next one's 50, next one's 50. Oh, I know, sweetie. Hey, you got to take a deep breath, okay? I'm. Oh, this is really falling apart on me right now.
Yeah.
I'm sorry.
No,
Sorry, guys.
no problem at all. I'll tell you what,
It's
Brett. Why
okay,
don't we
sweetie.
why don't we do this? Why don't there's 5 more slides left.
Okay.
I could cut it off here and we could come back later this evening.
Well, let me see what
And
happens here. They might be negotiating another
yeah,
peace
okay.
treaty, and we're Okay, let's try a little bit here.
All right. So, okay, expected 2022 outperformance. Obviously, oil is still far and away the top one. Emerging market
So,
equities has jumped up to number 2 here. Gold's
which we
been,
talked about last time, and I just want to start it again. I think the theory here that explains this is the idea that inflation isn't getting higher there in emerging markets. It's always higher, and now the developed world is suddenly higher. But it's not. It's like emerging markets are always dealing with these problems that we're suddenly
yeah,
dealing with in the United States. So we're just normalizing to an emerging market reality right now, and inflation in emerging markets hasn't even picked up really this year. It's always higher, and it sits there higher, but it hasn't changed on a second derivative kind of level. And so I think that's really it's about an asset allocation argument for this expected outperformance. And I don't know if it's really panned out too well, but I think that's the idea.
yeah. All right. Most crowded trades, obviously, long oil commodities. We talked about that dollar popping on here. That's now number 2. That wasn't even on the radar. So a lot of safe haven protection again going into the turtles, right, Brett? And moving along here, we've also got the short on treasuries. That's pulled back in, and I got an interest in TLT. We'll ask Brett about that here in a second. Short China stocks, that is on the rise. I disagree with that one, and I think that that's going to lead to a little bit of a um, reversal in the second half of the year. I talked about it with taking that Baidu long, but the way I see it is that most of China's issues are self-inflicted, and that's the one area that they could kind of afford to put in a little stimulus to work, and you're going to see that coming out to play here as we move along. And
Right. Say
then
say it again. I'm sorry, I'm dealing with it.
no problem. So, 3 things here, real quick, Brett. Long U.S. dollar, obviously a reflection of the turtle, right? That's moved into number 2 in the most crowded trade. The drop down in shorts on Treasuries, still crowded, but well below where we saw in May. I kind of like the TLT here with the idea of rates maybe topping out for a little bit. I don't know if you have any thoughts on that trade. And then the short China stocks, I disagree with this one. I think that China could set up as a nice second half play on the idea that that's the one area where it's really more self-inflicted than anything else, and they got the balance sheet to be able to kind of make a difference on that. You got Xi
China.
coming up for in China, and you got Xi coming up for his third election. So I kind of like China in the back half of the year. Do you have any thoughts on the dollar, the TLT, or China stocks?
So here's my thoughts on China. So what I think is so interesting about looking at the situation is we from the United States, from an American perspective, from a European perspective, we have we have democracies and capitalism, and what that means is people better deliver over a short time frame or they're out. And in China now he's testing the boundaries of this. I think with the zero COVID policy, I think it's a disaster. But you can have a very different time frame. You can take people through 5 years of pain for a 15-year gain. You can steer things in a way. You can all the reforms. The reforms that he announced 2 years ago, and over the last year or so, outside of the pandemic, just taking everything and saying that we're going to make a cultural transformation, and I don't care what asset prices do. I don't care about anything. We've got enough raw materials. We've got enough ability to just finance everything through. We've got enough ability to ease off and shepherd this through. But we're not looking for growth right now. We're looking for cultural reform, and that started a couple years ago. And I feel like that's an agenda that says, I don't care if, things are kind of crappy for everybody here for a few years, because this is not really a democracy. Like, this is not, but he could still lose power. And so I mean, that we've started to see, and I think the COVID situation, the zero COVID situation, is the biggest risk that he's faced. But you have a different time frame for what you can accomplish. So I think the short China stocks thing is kind of, to me, that's what it's been about. It's about that it's equity pricing and even company performance and all economic performance, all sorts of things are taking a back seat prior in terms of priority for a
Right.
period. And I think that that's what you really trade with China, is just looking at if he wants to juice up the market, he'll talk like he wants to juice up the market. He's going to deregulate things. He's going to let stuff fly, or maybe it's cultural transformation time, and we destroy all of the what was the online education massacre, and the billionaire massacre and these sorts of steps that he's taken where he's just said, you think there are rules, you think there's rule of law, you think there are standards you can bet on for foreign money. That's important. And we're just going
Yeah.
to take this out and we're going to destroy it right in front of you. No rules.
Yeah, but I mean, I also think at the same time too, he wants to roll in November with everybody
Yeah,
talking about how awesome China is, especially if the rest of the world is falling apart. So,
that would be, yeah, right. And it's not looking good.
yeah. Positioning, basically all along the lines of what we've been seeing here. Cash and commodities, healthcare, REITs. This is the position versus the historical averages. So you can see people are trying to stay in some of the safe havens. These REITs, I expect to continue to get hammered as rates rise higher and people get concerned about the economy. Obviously, equities near those lows there, Brett. Uh, so you kind of get an idea. It all plays into what we've been talking about. The underweight equities, it's actually up from May, but again, this survey was taken before the CPI, so I believe that this is probably closer to that 65% underweight in May. And then finally, this is an interesting chart because I think it kind of encapsulates everything we've been talking about, Brett. And I really like this
Mm-hmm.
chart here. You'll see all these numbers generally match up, except one. And you got to look at the Bank of America fund managers' high short-term
It's
rates
what we're talking
expectation.
about, baby. This is the thing where you said those three things can't happen together. This is
Right,
what we're talking
exactly.
about. This
And
is a
this
new
is
game.
This is the new game. So you look across minus 77 during .com, minus 75 for the great financial crisis, minus 9 for the euro debt crisis, minus 44 for COVID. Today, plus 79. And we could wrap it up with this capitulation watch chart here, Brett. Again, this is kind of the problem, right? Where
This is the
the
problem.
main tool that's been used to take us out from other financial crises is now the one that's causing this financial crisis. We always kind of knew it was going to come down the road, but it's really being emphasized here. And this chart, I think, just really shows that. So, what's your thoughts on this chart, Brett?
So back in December, we did a strategy meeting, and I at that point I said I think that 2022 could go one of two ways, and I think a lot of it hinged around, I mean, who knows what inflation is going to do? Perhaps it's going to work out better, but I thought, maybe China would steer away from zero COVID. That could heal supply chains. You could end up with this little bit of a window of Goldilocksness, but if not, um, something's going to break, and it's going to break bad because, and here's my reason. Um, the people who are in control of the money, the money managers who are in control of 95% of the capital in this world that's invested, are people who have never seen a world that looks like what you just said ever in their lives. They've never seen a world where you don't have the situation where the market goes down 10%, the Fed steps in and starts to, backstop things. Like they've never seen that world. And all these sorts of steps, they've gone for a decade and a half on really low rates, really cheap leverage, and they're making money by finding things they have faith in that don't move much, but they can lever up so much they can turn it into a big win. And that's the game plan that we've seen since pretty much the end of the global financial crisis. And that's because the Fed is going to be there. It's going to backstop things. So when you're dealing with that kind of strategy, you have this volatility amplifier, and anytime things move down sharply at any point, it's just it's multiples of that in people's portfolios who are playing strategies like that because leverage is cheap. So they're levering up. They're trading 40x their capital in terms of some of these positions, and that's because that's the game that's been working because you always could have absolute faith that the Fed was going to be there because they knew this. The Fed knows that this is what's in play, and that kind of everybody had the Fed cornered. The Fed had to do that because everything's going to fall apart if the Fed doesn't backstop these ridiculous strategies. But it kind of all feeds itself. If you've got rates that low, you've got leverage that cheap, people buy into those strategies. The Fed knows they're in those strategies. When things start to break down, it could get out of hand. So the Fed has to step in. That cycle, the cycle of life of the markets for the last decade and a half, could only happen if you have disinflation or deflationary backdrop, right? It's like kind of like what we talked about with Europe. If they can just print all the money in the world to backstop everything, it's okay because it all just works out. If you have a deflationary environment, you can just print whatever you want. But now it's all changed, and people who have ascended in careers and now control so much capital have no idea how to exist in this world, and I think they're just going to get blown up left and right, and we're going to see. I think that's why I've said, you stop being bearish when you start to see something really break, like things we're not even thinking of. Who knows what it will be, but something's going to break, and it's going to break bad in some way, blow ups, whatever. But it's predicated on the idea
Well,
that
it's
people
got to
don't
start in
understand
the
how to
credit
navigate this
markets,
kind of
right?
environment. What's that?
It's got to start in the credit markets, right? And we really
It's
haven't
well,
seen
yeah,
that
but
yet.
you don't know exactly where and what strategy is going to be. But I mean, just the idea that it's I think better when I think about it just abstractly. Just people have acclimated to a certain kind of universe with a certain set of rules for a long enough time that everybody who's controlling anything is absolutely acclimated fully into that, like a puddle into a pothole. They just fit it perfectly. This is what they do. This is their thing. And they probably don't have, in many cases, don't have the ability to just adjust and take on a different strategy. It's just going to be, well, we'll try doing more leverage then and hope the Fed comes to the rescue. What level is the Fed going to come to the rescue? And it's just not the same now. I mean, this slide is perfect to demonstrate why something's going to break.
Yeah. And that's kind of the backdrop that we're operating in here. So, all right, Brett, I think that's going to do it for us then today. I appreciate you coming on and joining us. I know you were concerned with the triplets. I thought that they did a pretty good job.
I think they did. Yeah.
So it is what it is at this point. But we got the important details out of the way here. Ran a little bit longer than we were trying to get these done in closer to 45 minutes. So obviously ran a little bit over. But I think that was important that we met today, talked about the markets today, given the backdrop, since now we're through the Fed, and kind of get an idea. I think both of us are still leaning in the bearish camp, waiting for some better signals of capitulation here.
Yes,
It's
but
not
I
to
would
say,
remind everybody of that bull ratio chart with the
yep,
10-week moving average. Like, it doesn't mean it's going to be tomorrow, but it's reminiscent to me of when we started to approach Brexit. And, in April, May 2016, even though that was a very different looking chart, it was still a similar situation. I think there was like 70 out of 74 weeks where there was more bears than bulls. In, like, I mean, it was like a year and a half of, as soon as the commodity space started to break in late 2014, early 2015. It just kind of turned into this malaise. And then there was a period as we approached Brexit where it seemed like everybody on the planet was certain we were going to see the market crash, and you see the positioning come in, and then you get around the corner, you get past the major event, and suddenly people just start to see the world a little differently. And so people are not positioned for things to get better. So that's the main thing to know. Doesn't mean the market's going to go up, but you do know that if things do change and you wake up one day and you're like, well, things are changing, better way, inflation's way down, the Fed is revising its outlook in terms of how much it needs to hike, suddenly all of Wall Street's convinced they can do the soft landing, Putin pulls out of Ukraine. Who knows? But if good things start to happen, no one's positioned for that right now. That's what you know. Doesn't mean the market's got to go up, but sometimes it's not the case. Sometimes everybody's betting on things getting better, and they're already in those positions, and the shorts have already covered, and then things get better, and it sort of fizzles. But in this case, if there's a dramatic kind of sea change in reality in terms of some of our base kind of issues with this market, from that chart that no one's positioned for it, and this market will take off if that shift happens. It may not happen. It probably won't happen. But I mean, obviously, that's why people feel that way. But if it
yeah.
does,
But
people are not
I would
positioned for
argue
it.
that any of this stuff that you're talking about, that change, it's going to take a couple of months for that to play out.
Which is exactly why people feel that way. It's exactly why.
I think the one headline that you could see that would be the face ripper rally would be some sort of peace talks between Russia and Ukraine that have merit, obviously.
Yeah, and I still
But
believe that the China zero COVID is significant if they would
it
change
cer-
that game.
It certainly is. It seems like they're more willing to double down on that at this
Yeah, it
point, though.
certainly does.
But I mean that's why that short China trade, being overcrowded. And I guess that would point to your positioning. I just took that long in Baidu. That's the most self-imposed. Obviously, Russia is too. I mean, they could decide to pull out
Yeah,
at any time. But I
certainly.
think that the problem is both of them, the two autocrats, have way too much ego to just pull
Well,
out
and
and
they've
correct
got this
something
longer
that they're
time
wrong.
frame. What I
Yeah,
was talking about is like Putin's not up for re-election. Xi's not up for. I mean, they are kind of, but really, it's an inside baseball game. As long as they can keep control over their little group and their little structure and their little system, the outcome is theirs to shape. It's not, here in the West, it's a vote.
yeah,
There, it's a managed game as long as they don't lose control of that, that internal power structure. Then, and Putin certainly has power. I mean, he could just push a button and take away every oligarch's money, every bit of it, at any time. So, the oligarchs are simply the people who divided up the public goods in 1990, whatever, early 1990s. That's it,
yeah.
right? They shifted away from communism. The people owned the oil fields, and if you knew the right people when we were going to shift away from that, well, then my friend Joe here is going to now own the oil fields, and that's the oligarchs. But there was a clause in there that basically said at any time, the person who's in charge can just take all of it away with just you know, he can just, Putin could just decide to take it all away. So he's not going to lose that power. So he can do whatever he wants.
All right. So we will end the conversation at that. If anybody's got any questions, feel free to write in. We'll circle back around and answer them. And Brett, again, thanks for joining us. Thank the triplets for their efforts. And we'll be talking to you soon. I think we're doing a trader strategy meeting next
Next
week
week, yeah.
on Wednesday, I believe. So we'll have Brett back on the air for that. And until then, we'll be keeping an eye out for your trading in the futures, Brett.
All right. Sounds good.
All right. Thanks a lot, everybody. I'm going to shut down audio here and restart it up to cover the last 15 minutes or so in the market. So we will be done here just for a little bit, but I'll be back on shortly.